fairly commonly held view through much of 2007 that the decline was just subprime mortgages. The rest of the mortgage market actually had not declined very much. It did later in the year. And if you remember, the equity markets actually peaked in October of 2007. So most of that year, there was a lot of bullishness still in the market,
right,
other than the subprime mortgage market.
Right. But you could have sold it long, dealt with it that way without going short. And the reason I think we all keep coming back to this is because it's hard. It really is hard for me to see. I mean, there's a clear conflict of interest, right, when you have a client out there in a position that you put him in, and you are at the same time selling that position short. I mean, I'm not saying it's bad. I'm just saying it is a conflict of interest, isn't it?
Not necessarily.
No, I'm not saying necessarily. I'm just saying in general, if you're selling a client something long, you're saying to the client, hey, it's still time to buy RMBSs, and we're selling to you. At the same time, you're going short. I think that just causes concern. I'm not saying it's bad. I'm not saying it's illegal. I'm not saying anything else. I'm just saying it just seems to me that it's a tough conflict of interest that you have to deal with. You probably have to deal with every day, and that is.
Yeah, I actually don't view it as a conflict because we change that. We sell someone a security. Their investment horizon is generally a fairly long time.
Right.
We make decisions on a bias on where we want our risk to be.
Right.
That could be a very short-term decision. It could change the next day.
Right.
And so what we do when we sell someone securities, we make sure we fully disclose to them what they're buying, what the risks are, and then they make their investment decisions over whatever time.
But you were selling these mortgage-backed securities during this whole period. I'm not talking about just buy and hold. I'm talking about the day after you sold something short, you then were selling something long.
I'm not sure. I
mean, to clients, not for your own account.
I'm not sure I know individual securities, what we bought, what we sold.
So you just stopped selling these mortgage-backed securities when you started to go short?
No, we were still selling things, but again, as I said, Dr. Coburn,
right,
that just depends on the price you sell it, and if somebody thinks it's a good investment.
I'm not saying there's anything wrong. I'm just saying, if I'm selling things short, and the same day or the next day I'm selling a client a long, that just seems to me there's a conflict in there, whether it's resolved or not, or how it's resolved. But it just seems to me that's a tough call in terms of which we got into the earlier panel. What is my responsibility to my client? And I know you use and everyone does this kind of, well, they're all big boys and they all are investing long and they know what they're doing. But that to me doesn't, and while I think that's true in many cases, that still doesn't rule out the fact that you're doing one thing for yourself at the same time you're doing something to one of your clients.
I don't view it that way, okay, again, because our positions change quite often.
You can just agree to disagree.
Okay.
Have you heard about the Lehman Brothers use of so-called repo 105s?
I have heard about it, yes, I've read about it.
And what's your understanding of these transactions?
Only from what I read in the newspaper,
right,
that they treated things as sales that were going to come back on the balance sheet. I don't know the details.
Right. And why would they be doing that?
I
don't know. Okay. I think the best way to explain it, there was Lehman structures repo agreements to mask its true net leverage ratio through an accounting device known as Repo 105, whereby it raised cash in repo transactions by selling assets that were 105% or more of the cash it received, allowing to treat them as a sale rather than financing. As explained by the New York Times Deal Book, that meant that for a few days, and by the fourth quarter of 2007, that meant end of the quarter, Lehman could shuffle off tens of billions of dollars in assets to appear more financially healthy than it really was. What do you think about that? Not for Lehman Brothers. What do you think about the concept as reported by Deal Book?
I think as far as Lehman Brothers, it's a better question for them.
Oh, okay, suppose there was a firm out there. We're not talking about Lehman Brothers. Let me put it this way. Would Goldman Sachs ever do something like this?
No, we did none of those transactions.
So if you can say here that Goldman Sachs never engaged in transaction near a quarter's end to improve its balance sheet.
We never engaged in Repo 105 transactions.
No, I'm asking.
Anything we did near quarter end, if we took something over our balance sheet, it was because we sold it.
But I'm just saying, so it's clear, therefore you never engaged in a transaction near the quarter's end to improve its balance sheet for investor reporting purposes.
We would do transactions at quarter end where we would sell things.
Right.
Then we had risk we couldn't buy them back. We would do other transactions at other quarters where we would buy things.
And do you have any transactions you did at the